Assalamu alaikum and hello everyone. Welcome to MFRS 10 Part 2 Slides Presentation. Before this, we already had our Part 1 and we were discussing on the key criteria for the control, which is power. So there are 3 key criterion. And we have discussed the first one, which is power. Under that discussion, we have already spoken about the existing right. So existing right, we have talked about it. And what we are going to do now is we also have talked about the current ability, which is in the power, the meaning of power. And now we're going to talk about the relevant activities. So we're going to talk about the third element of the definition of power, which is the relevant activities. Okay, the relevant activities was defined in MFRS 10 Appendix A, where that is defined as range of operating and financing activities that significantly affect the investee's return. The word significant means these activities is the one that has given the highest contribution towards earnings of the company. And therefore, we want to see what are the example of relevant activities and what are the range of operating and financing activities that will significantly affect investees' return. MFRS 10, the Appendix B, paragraph B11, has given some examples of relevant activities. If you look at the first one, selling and purchasing of goods and services. This is normally the activities that are done in the ordinary course of business. Let's say we talk about retail business. They buy goods for the purpose of reselling it. So this is the example of relevant activities that normally happen to the case of a supermarket, right? Maybe Aeon, right? They have the selling, they purchase their goods, and also they provide services, delivery services. They also provide some kind of services which are often to the request of the customer. The second one is managing financial assets during their life. Some companies or some entity do not provide goods for sale, but what they do is they take our money, they manage our money, cash for example, which is their financial asset, and they try to maximize the return for the so-called depositor. So therefore, this is also a relevant activities. This might be for fund manager, right? They manage financial assets of their customer. Or maybe you have another activities that are also relevant depending on the nature of the business. Let's say you have a property developer that maybe they select what are the property that they want to buy, and then they acquire it, and later they dispose of the assets, the property. So basically, this may be in terms of having a lot of properties business in Malaysia, where this is the nature of the business. So these are the relevant activities. So the relevant activities includes but are not limited to what you have in paragraph B11. Or some companies like pharmaceutical companies, they don't really provide services, but they do a lot of research work. At the end, they develop through the R&D project new products or processes. New products, for example, the vaccine for COVID-19, right? Or maybe a better process towards improving the customer's experience. but let's say a pharmaceutical company, the products are later sold off to the pharmacies. Or maybe certain companies, certain activities which are relevant, they decided the funding structure for a customer. They decided, and they also try to obtain funding for the customer. This happened to company like Perodua, where they sell cars to us, and at the same time they try to get the funding for us, the financing, okay. So either funding or financing, that might also be a relevant activities, because if they could not afford to get the source of financing, maybe the car owner or the prospect customer may not be able to purchase the car. So obtaining funding is an example of relevant activities. It's not very clear-cut to assess relevant activities, and that is very critical to decide which one is a relevant activities. An investor has the current ability to direct only some of the investees' activities. Sometimes decisions are not just made by the parent company. Decisions about other activities are taken by some other parties, or maybe through some shared decision making. The most important thing is to look at who makes this overall decision about the most significant activities, which is the relevant activities. And the entity or the person, which generally is the board of directors, that control those activities, the decision made by them. So therefore, this is normally going to be the decision that will generate the future economic benefits for the company. So who makes this overall decision will also be able to help you to decide what are the relevant activities. But this is not really going to be an application issue for the case of introductory course to group accounting. So these are some of the examples of decisions that are made relating to relevant activities. As I mentioned, establishing operating and capital decision of the investee. You decide on behalf of the investee what would be the capital decision of it. You establish that. And maybe that includes also a budget, capital expenditure, for example, the purchase of, let's say, a purchase of a PPE or purchase of a plant, right? So that is decided with the majority vote of the board of directors that comes from the parent. Appointing and remunerating an investee key management personnel or service provider. So if the key management personnel or the top management is being appointed by the parent company, the one in the investee company are appointed by the parent company. Therefore, these are also an example of decision about these activities, because they are the ones that are likely to make decision on what are the relevant activities for the investee companies. We go to the next one, which is still in the definition of control. If you can still recall from our previous slide here, just go back for a while. When we talk about power, right, we are also saying that the relevant activities are activities that significantly affect the investee's return. So now we're going to look at the part on return. Right, just wait. So the first key element that we have discussed is power, right? And the second key element in the definition of control is about rights to the return. And when you actually has the power to affect the return, you are actually having the control. That is according to MFRS 10. Right. So let's look at what are actually variable return, or what is meant by exposure to variable return. To have control, investor must have exposure or rights to the variable returns. So the criteria may be satisfied when investor return from the investee company can vary because of the investee's performance. What is actually variable return? These are returns that are not fixed and have the potential to vary, to change, to either fluctuate, to either increase or decrease as a result of the performance of the investee, as a result of the profitability of the investee, or the performance in terms of earnings of the investee. Variable return can be only positive, just the positive, or maybe only negative, or both, positive and negative. What you need to do is that an investor need to assess whether those returns from the investee are variable, and how variable those returns are on the basis of the substance of the arrangement, and that is regardless of the legal form. And according to MFRS 10, the return should be interpreted broadly, right? That should also include synergy benefits as well as financial returns. Okay, let's look at the next one. That is for more detail. You can refer to MFRS 10, paragraph B55 to B56. So these are some example of variable returns. These are like dividends, because dividends will vary, will change, as that is depending on the profitability of the company. Other distribution, for example, interest from debt securities, interest that you have from your investment in debentures. It will depend on also the debentures security itself. Changes in the value of investment, remuneration for service, fees, residual interest, tax benefit, and the list goes on, right? That is according to MFRS 10, paragraph B57. This variable return means the return is not fixed, just like dividends. Dividends are not always the same each year. It depends on the profitability. Or maybe we are talking about fees and exposure to loss, right? These are also not fixed. It is variable return. These are the examples that you can go further in paragraph 57A, B, and C. So the next element, after you have assessed what is power and what is return, or more specifically, whether the company has exposure to the variable returns, is to assess what are the link between the two. When I say the link between the two, means between power and return. So as an investor company or the parent company, you need to assess whether do you have power over those relevant activities. Meaning to say that, is your company, the investor company, is the one that generally be the one that make the decision, the overall decision about these most significant or relevant activities. Are you being exposed to the variable return? Do you have a share to that variable return? Let's say the investee company declared dividends. You will have the share from the dividend declared by the investee. So dividend itself is not going to be the same each year. The third one is what are the link between the two? Do you have the ability to use the power that you have to affect the returns from the investee. If this is satisfied, you can now decide whether do you really actually gain the control. You can decide this too, the link between the power and the return, to decide whether there is a control. So you need to go and reassess control if facts and circumstances suggest a change in one of the three elements: the power over the relevant activities, the return, power, return, and also the link between the two. So you need to go and check that. Next, you go and refer paragraph B58 to B59 for further explanation from the MFRS. The following factors. So now we would like to assess whether do we have control in our investee. How do we know, or what are the factors that we should be assessing to know or to decide whether an investor or the parent company, or before it becomes a parent, it is an investor, right? So whether or not there is a control in the investee. If there is a control, or you have gained the control, then only it becomes your subsidiary and you become parent. Look at the first item. Look at what is the purpose of the investee. Look at the design of the investee. Look also at the relevant activities of the investee that would affect the return. Remember, the variable return. Look at how decisions about these relevant activities are being made. These are being included in the MFRS, but I have already rewrite that to make it easier to be in the form of factors. Whether the right of the investor gives them the current ability to direct the relevant activities. The current ability to direct the relevant activities is about power. Whether those rights give you the power. And whether, as an investor, are you being exposed or has the right to those variable return? And what is your involvement with the investee, right? So from your investment with the investee is the one that will later affect or change the variable return. How actually do you involve in decision making of the relevant activities in the investee? You also need to look at the ability, your ability. Do you really have ability to use power to affect the return? And look at how the link between the power and returns that will actually give rise to control. So let's go and look at the accounting requirement, assuming now that you are a parent, right? Before you are a parent, of course, we have decided that a parent will be the case whenever an acquirer has a control in an acquiree or the investor. In the case of MFRS 10, the term used is investor. Has a control in its investee. But if you still recall the one being used in MFRS 3, they make use of the term acquirer versus acquiree. Whatever it is, when you have determined who is the acquirer will always be the parent, right? Will always be the parent. And a parent company is the one that will prepare financial statement using uniform accounting policies. And we're going to do this later in a work example according to whatever step or consolidation procedure. We are going to consolidate the transaction and other events. And the consolidation will begin from the date we obtain control, and it will cease from the date we lose our control. MFRS 10 set out guidance for the preparation of consolidated financial statement that was set out in Appendix B 86 to B 93. However, some parents are exempted from preparing the consolidated financial statement. So there are 4 situations. If the parents meets all 4 situations, then only parents will be exempted. Parents itself must be a wholly owned subsidiary, or is a partially owned subsidiary, and the other owners are informed. If you are a wholly owned subsidiary to another parent, so therefore you don't have to prepare the consolidated financial statement of your subsidiary, because your parent will be doing that. All right, and if that is a partially owned subsidiary, if you have a partially owned subsidiary, the other owners are informed and do not object. So if the other owners have been informed and they do not object, then only the parents do not need to prepare consolidated financial statement, because some other parent will be doing that. Let's say we talk about having an ultimate parent, intermediate parent, and this is the subsidiary. If this ultimate parent does, intermediate parent do not have to present the consolidated financial statement. Number 2, the parent debt or equity instruments are not traded in the public market, or they including the local and regional market. So they are not a listed company, not a publicly listed company. Next, the parent did not file or in the process of issuing in public market debt or equity instrument. So they are not trying to issue shares or issuing debentures to the public by filing the financial statement with the regulatory authorities. Like in Malaysia, we have the Securities Commission. So meaning to say that they are not in the process of becoming publicly traded company. They don't issue shares and debentures to the public. They do not file for that process of issuing. Or the last one is that ultimate or any other intermediate parent produces the consolidated financial statement. So if let's say, as I said just now, you, I, and let's say here 80%, there is a control, right? And I hold 60%. I is a parent but intermediate parent. You is a parent to I and also a parent to S. So therefore, I may not need to prepare the consolidated financial statement if you has done so. Yeah, meaning that I is a subsidiary, partially owned subsidiary of you, and you agree, which is ultimate parent agree. So therefore, if that is no requirement for the intermediate parent to publish the consolidated financial statement. Exclusion of a subsidiary from consolidation. MFRS 10 allows a subsidiary from being consolidated, meaning that parents still prepare consolidated financial statement. And let's say the parent has 2 subsidiaries. One of the subsidiaries are not being consolidated, and that is being allowed if the investment in the investee or in the subsidiary are those held for sale with MFRS 5. If that are not within the context of MFRS 10 and now it is held for sale, you have intention to sell it. Or maybe when parent loses control over a subsidiary and you lose a control, there is no more control, but maybe that becomes under the provision of MFRS 5, non-current asset held for sale and discontinued operation. Or maybe it is no longer a subsidiary, investment in subsidiary, but that becomes investment in financial assets, where if that is investment in financial asset, you will have to actually account according to MFRS 132 financial instrument and MFRS 9 financial instruments. MFRS 132 is on presentation and MFRS 9 is on the financial instruments itself. Remember, MFRS 9 replaced MFRS 139, right? MFRS 9 is now in force. Let's look at the next one, temporary control. These are issues when you have your subsidiary being consolidated. If the control in the subsidiary is temporary, meaning that you have a view to for a resale, so therefore it can be excluded from the consolidation, provided that the sale of the subsidiary, you have intention to sell the subsidiary within 12 months. So therefore, at the same time as well, the management, which is the parent, is actively seeking a buyer. So they are trying to sell, meaning that it will change from under investment in subsidiary, which is MFRS 10, accounted under MFRS 10, and now that will be accounted as MFRS 5 if they find the buyer and they have the process being completed. Or if the subsidiary was still not disposed within 12 months, it must be consolidated. So let's say after 12 months, still it is not yet disposed, you must consolidate starting from the date of acquisition. You cannot cease consolidation. Okay, let's look at the loss of control. So parent will gain control if they acquire more than 50% of the shares, equity shares in another entity. That was just a simple indicator that there is a control. Of course, we know there were many more factors that could give rise to control. However, if a parent no longer controls a subsidiary, at the date the control is lost, let's say that date the control is lost is 31st of March 2021, and your year end is 31st of December 21. So it's not yet year end, I know. However, on this date onwards, when you have no more control, let's say from 70% control, it goes down to 30%. So it is no more under control, right? So if that is the case, the parent shall de-recognize the asset and liabilities and non-controlling interest. We're not going to do this. Yeah, this will be done in your advanced study. I'm just talking about the theory side of it. Recognize any retained investment, if there is retained investment, if it's an associate, if it's a joint venture, if it's a financial asset, it should be accounted for accordingly. Reclassify the profit or loss, transfer them to retained earnings. This is similar to what you have done in certain MFRS. MFRS 116, for example, you do this. And recognize a gain or loss associated with the loss of control when you dispose an asset, which is your subsidiary company, the investment. So therefore, that will also give rise to any gain or loss on disposal of subsidiary. So the disclosure for consolidated financial statement is not included in MFRS 10. Entity that applies MFRS 10 is also required to apply another MFRS, which is MFRS 12, disclosure of interest in other entities. And this MFRS set out the comprehensive disclosure principles, including this, whatever that are related to the consolidated financial statement should be observed by the investor, and it should be presenting the consolidated financial statement according to the comprehensive disclosure requirement and the principle. Okay, this one you can just read it on your own. Next, I'm going to move on to group structure. Okay, the group structure is going to be few things that you can see is that what are the first one, what happened if it is a fellow subsidiaries. So fellow subsidiaries is the case where you have a parent company, I put P here, where that parent company have some controlling interest here 100% in a subsidiary, as I denote it as S1, another direct control in S2 80%, and 51%, which is just enough to get control in S3. So the control is by one parent, but it has few subsidiaries. That is why it is called fellow subsidiaries. But for our focus in FAR 320, our focus will just be one parent and a subsidiary. We're not going to have one parent with 3 subsidiaries or 2 subsidiaries. That will be done in your advanced study or in your professional level, right? So the investor P, when we talk about single group level group structure or single group, investor P has direct controlling interest in the acquirees S1, S2, S3. And these are called fellow subsidiaries because the interest is directly by just a parent. And control is assumed to be exercised here when the parent owns controlling interest directly or indirectly through other subsidiaries. It does not need to be direct, but it can also be indirect. Then I'm going to show that in a short while. Unless it can be clearly demonstrated that such control does not exist. So you can also see that sometimes with majority voting power, you don't have control. Okay, for our course, our focus will be on one parent and one subsidiary. And this is just for the purpose of knowing the theoretical framework or the theoretical application under MFRS 10. Okay, another one is you may have fellow subsidiary, but it is a wholly owned subsidiary. Wholly owned subsidiary is a subsidiary where you have direct control and you control all 100% of the voting shares in subsidiary. Like the case of TV3, yeah, remember, or New Straits Times, when once upon a time you have it. It is a direct control of Media Prima and the shareholding was 100%. The acquiree is termed as wholly owned subsidiary, so no non-controlling interest there. Let's say P acquired a direct interest of 100% in S, equity share capital, here is S1, and this 100% holding is described as a controlling interest, and that gives the P an absolute or complete control over S1. And S is now termed as wholly owned subsidiary, and there are no NCI, non-controlling interests. P will consolidate S in its group financial statement in full, yeah, regardless of how much is the asset, liabilities, income, equity. Okay, we now move on to still under fellow subsidiary. If what happened if we have a partially owned subsidiary, when you do not have or you do not control all the shares in the subsidiary, you do not acquire all the shares in subsidiary, and somebody else or some other shareholders are also sharing it, not sharing, are also acquiring the shares. These are the case of partially owned subsidiary. You do not have control 100%. Here P acquired the subsidiary S2 80%, direct control, and P owns a direct interest of 80%, issued on share capital, which is the voting share, and this 80% is described as P's controlling interest and gives P also complete control. Even if it's not 100%, P has the complete control. And S2 will be described as a partially owned subsidiary, and as it is not wholly owned subsidiary. Other parties or the shareholders that own the remaining 20% of the share, they have an ownership interest. They are the non-controlling shareholder in S2. However, they do not have the power to direct the decision making or power to actually affect the decision made in the subsidiary company, right? They are not the one that make the decision. It is the parent. Overall decision is by P. And these parties or shareholders are described or termed as minority shareholder, or now they call it non-controlling interest. Again, MFRS 3 that we discussed earlier, the interest of the non-controlling interest is termed non-controlling, the interest of the non-controlling shareholder, in the operation of the net asset is what you call non-controlling interest. And I've already mentioned about this in my previous slides. This is the one just for knowledge. Vertical group structure is where you have P acquire control in Q. Q is a subsidiary to P, but Q as well has its own subsidiary R. Q acquire 60% interest in R. So this happens when investor has direct controlling interest in subsidiary company Q. For example, P is the investor. P is the ultimate parent. Q is also a parent to R, but Q is an intermediate parent. Q has a direct interest of 60% in a subsidiary, so it is all actually an intermediate parent. R is a subsidiary to S, and it is a subsidiary to P. Okay, so if that is the case, Q berhad is also a direct subsidiary to P, and at the same time, it is an intermediate parent to R. However, P berhad is the ultimate parent. As an ultimate parent, it has a direct interest of 70% in Q. At the same time, it also has an indirect interest of 42%, which is 70 times 60%, that gives you 42% in R. So even though it is less than 50%, which is not even a majority voting or majority interest, this 42% is still a controlling interest. Why? Because it is a subsidiary of a subsidiary company. So what you can conclude here is that R is an indirect subsidiary of P. You can read this on your own. The next one is a mixed group structure, just the theory part. This happens when P has control in R, okay, 30%, not a control, that is not a control. However, through Q, that is a subsidiary of P, Q acquire shares in R of 60%, and because Q is a subsidiary of P, indirectly R is also going to give some indirect interest to P. So indirect interest of P in R is going to be 42%. So let's look at what I have explained here. Direct interest 70% in entity Q berhad, and 30%, this is the direct one. This is direct interest, I put here D. This is direct interest, because directly, right? At the same time, Q acquires shares in R. So Q and R direct by Q, right? And then you can see P berhad the ultimate parent P Berhad now has a combination of indirect interest of 42%, which is 70% times 60%, so 42%. And it also has a direct interest of 30% in R. This is the direct interest. And the indirect interest is here. Indirect interest, I put ID. And that was 42%. Direct interest is 30%. So if you total up together, the total controlling interest is 72%, where direct is 30%, indirect is 42%. So it makes up 72%. Now, next one is about the associate company. This is just theory. When you have shares between 20% to 50%, either directly or indirectly, in another entity, not even a control, 20%, 30%, 40%, that company is presumed to be your associate company unless it can be clearly demonstrated that there is a control. The percentage of equity shares acquired, which is between 20 to 50%, is generally giving you the significant influence over the investee company. I'm assuming you as the investor. The investee now becomes an associate company, and that will not be consolidated, so no consolidation will take place, but it will be accounted for under equity method under MFRS 128. You will learn that if you go and pursue more in accounting, right, for your degree or for your professional ACCA or your whatsoever qualification like CIMA, or maybe things that you may want to venture into. MFRS 128 define the significant influence here, the power to participate in the financial and operating policy, but do not have any control or joint control. MFRS 128 is not in this course syllabus. We just mentioned about associate company. So here I'm giving you the summary of the percentage of equity interest acquired in the investee between 0 to 100%. And where you have the summary for the first part is the consolidation that will only take place if there is an outright control, when there is a parent-subsidiary relationship. And so you're going to account as per MFRS 10 and treat that as also per MFRS 3. But this side here on your left side, financial statement of this investee company, will not be consolidated. So you will not apply MFRS 3. You will also not apply MFRS 10. This one will make use of MFRS 9. Associate will make use of MFRS 128. If you hold shares less than 20%, there is just a simple investment of financial asset and there is no consolidation required. So no consolidation, no consolidation. Same goes here, no consolidation as well, no, right? So that is if you have a joint control where you contractually share control with others, right? You can write that. Okay, the consolidation procedure. So we will stop at this slide. Step 1, where you are going to combine like items, we'll be doing that. This is the consolidation procedure to prepare the combined financial statement. So if there is a statement of profit or loss or statement of financial position, that will be combined. Same goes for cash flow. We're going to combine the result of the parent with those of all subsidiaries. Then you're going to offset the carrying amount of the parent investment in each subsidiary. We'll be doing that. And the parent portion of equity of each subsidiary. We'll be doing that in our next video, showing how to prepare the financial statement, which is the consolidated financial statement, using this consolidation procedure. Step 3, you need to offset and eliminate the intra-group asset and liabilities, or what you call intra-group transaction between the entities, between parent and subsidiaries. Any transaction that are just between parent and subsidiary in full. These are the steps to prepare the consolidated financial statement. In general, you can check that. I'm going to show you step by step how to do that and what is the process of consolidation. With that, I finish with my theoretical explanation, my slide presentation on MFRS 10 and MFRS 3. Please refer to the MFRS itself, refer to the textbook for more details, refer to MFRS 3, refer to MFRS 10. Refer a lot to the textbook, especially go and work out those examples given. And please go through the slide again. Please listen to the video again if you need more details and you need to repeat on certain parts. With that, I thank you for watching. I'll see you when I will see you. I'm signing off from the presentation of my theoretical notes only. With that, Assalamu alaikum and have a good day ahead.